Good afternoon, everyone. Welcome to today's webinar, Volatility in Real Estate, Short-Term Issues and Long-Term Potential. My name is Tim Herriage. Glad you are here. I am joined by some dashing young gentlemen. Not sure how they appear on everyone else's screen, but Randall Henderson, Brad Hunter, and Michael Finch. So I need to make sure this is being recorded. Not quite sure how to do that. I'm assuming
it is.
It is? All right, good deal. All right, so we've kicked off. Good afternoon. My name is Tim Herriage, Executive Director, RCN Capital. Thank you for spending your time with us today. We are excited to bring this panel of experts together from the SFR Advisors or Alliance and from the SFRHub. Today, I'm joined by Randall Henderson of Property Management Incorporated, Brad Hunter, Hunter Housing Economics, and Michael Finch of SFR Advisors. So, folks, let's just dive right in and we'll introduce ourselves and a little bit about our companies, and then we'll get to the meat and potatoes, the reason everyone's here. Tim Herriage, RCN Capital, one of the leading, if not the leading, single-family investment lenders for real estate investors in America. DSCR Lender of the Year, according to IMN. We're excited to be here. And Randall, why don't you go next?
Hey, thanks, Tim, so much for the intro. It's been a long time since I've been called young and dashing, so I really appreciate that. I think the gray hair on the screen kind of negates that. However, guys, I'm Randall Henderson, Vice President at Property Management, Inc. We are the largest property management franchise in the country. We're managing over 100,000 properties. I'm excited to talk to these guys in the perspective of a landlord and a property manager and kind of talk about the renter demographic and add my view on the investor of today. So thanks for having me.
Excellent. Thank you, Randall. And, you know, perception is reality. Next up, Brad.
We do housing feasibility studies all around the country, and these days about 80% of our work has been built for rent single family and all the different flavors within that broad sector.
Brad, Mr. Finch.
Thank you, Tim. Appreciate you moderating the panel, and thanks to RCN for putting it on and inviting us all here to speak with you all today. Michael Finch, I'm one of the principal founders of our SFRHub companies. We own and operate the largest national commercial brokerage in the SFR and build-for-rent asset class. We own and operate the leading data research and valuation platform, again, 100% focused on SFR and BFR. I think we've underwritten almost about 100 billion of single-family homes. About half of that's been BFR over the last number of years, and tremendous amount of data in the space. And then we own and operate SFR Capital Management, which is a asset management and operating company acquiring 35,000 build-for-rent homes over the next 5 years. We are starting on our first 28 communities this year and started deploying capital come end of February or March on our first homes.
Excellent. Well, gentlemen, thank you again for agreeing to join us today. I want to dive straight into inventory levels, and I think I'll kick this to Brad first. Brad, let's talk about available for sale inventory. Can you talk in general about some trends you've seen in the last 12 months and kind of where you think we'll head in the next 12 months?
Building industry lately, because obviously the spike up in mortgage rates caused a lot of people that were under contract to fall out of contract, and that's reflected in a huge increase in cancellations. KB Home recently reported 68% cancellation rates. So that's a problem. But thankfully, and again, we go back to that built for rent aspect that's growing so much, and many of the builders are pivoting towards build for rent as a way to lay off some of that inventory and reduce some of their market risk. And we expect that to be a growing trend throughout the next 5, 6, 7 years.
Excellent. Brad, thank you. Michael, what do you
I think,
guys?
oh, sorry, I didn't realize I was muted. I was just adding to what Brad was saying. I think a lot of people saw that KB article come out in December, but the home builders that we've been working with for years, I mean, they've been dropping land deals, walking away from earnest money on parcels around the country, and then in some cases, many have turned to build for rent operators to see if they could hold on to those positions. But given that so many have dropped land deals in the last 6 to 8 months because of the slow in retail sales, it's just further adding to the lack of supply that's on the market. And as Brad mentioned, most of the home builders, publics, regionals, and locals are turning to the BFR groups to try to help keep them busy, keep their subs busy, keep them into positions that they're further along in subdivision that they can't drop, and trying to salvage opportunities to do what they do, which is build homes.
Randall?
Yeah, just to add to that, in terms of what impact that has had on the existing single family inventory in terms of rentals, it's been really interesting to see, because that's put a squeeze on the inventory on this side as well. So when you have these tenants that are no longer looking at these pre-builds or the build for rent community slow down, all of a sudden it eats up the remaining inventory in the single family space. And although we may not see the rent increases like we saw a year ago, we definitely have seen a squeeze on the inventory side, and that's probably going to stay that way for a while.
Ultimately, Randall, that's a great point. And I think what I've been seeing really at the ground level, not only in my investing business, but also when we look at average loan amount, is affordability is a huge driver. And I think the number is somewhere near 90-something% of active mortgages are below 5%. And so when you look at the typical human trends of move up, move down, empty nesters, it's the higher interest rates, I think, are compressing prices, but it's also making homeowners stay put, because if they have a 3 handle on their mortgage and they decide to sell their home and downsize, so to speak, their payment on the smaller home may be 10%, 20% more than their payment on the larger home. So I feel like there's some underlying dynamics at play, and that's where I really want to talk into supply and demand, because you all really just touched on builders aren't really building, and if they are building, I drove by a subdivision yesterday. It was all frame houses, and like the floor plans are much smaller, and they had the white sticky tape over the starting at number, right? Because it used to say 500 and now it says 300, right? Like starting in the 300s, and you're like, starting in the 300s, and we will give you async, but maybe not 2. And so it's been interesting. So let's kind of pivot to supply and demand and talk about where we are from an absorption rate, a population rate, and kind of where you gentlemen see that going.
I'll jump in real quick, just to add one more point. There was a stat that was circulating in October indicating that, somebody that could pay a $2,400 mortgage was able to afford a $575,000 house and that was in January of 22. By October of 22, that same mortgage rate of $2,400 could afford somebody a $373,000 house. And I know Brad's seeing this, but what's coming to help that affordability is that builders well, it all starts with the land, right? So land costs need to come down a little bit, but also increasing density in subdivisions and building smaller homes, on smaller lots will help the affordability issue as well as the supply issue. I think most have thought, I guess more academically, post last recession, builders should have been building smaller homes coming out of there, and they didn't. They were continuing to build, 2,200, square foot 3 bedrooms, 2,600 square foot 4 bedrooms, and those aren't real starter homes. Those would be arguably move up homes, but that's what they were building because land costs were up and material costs were up, and they had to build more expensive homes to get their margins. Where moving forward, it's becoming quite clear that builders need to start building smaller homes, to help the affordability challenge, and that will coincidentally help the BFR buyers as well, because smaller homes are more in line with a BFR home anyways, or an investment home, because renters don't pay like a for sale buyer. They don't pay more to have more space. There's a ceiling in the rental market, and that ceiling's already been hit in the for sale market, which is where we're at today. So I think as costs come down, density increases, smaller homes are developed and built, that will help the affordability challenges that people are facing today, especially with higher rates. So if they settle at 5%, in 18 months or however long it takes, buying a 1,500 or 1,600 square foot 3-bed, 2-bath home as opposed to a 2,100 will help the builders maintain their margins and will help the buyers, afford a quality home. It just might be a little bit smaller of a home. And then that in turn will help the BFR investors because the builders are already building inventory that makes sense for people that choose to rent.
Tim, it looks like you're on mute, but I'll jump in if there's an opening, because I just want to add to that.
I was pitching it to you because he said people that choose to rent, and I wanted to pitch to the property manager. I muted him, I unmuted you, and I left myself muted. Go ahead.
I've got you. No worries. The other statistics that's important here to speak to Michael's point is this. From the middle of 2021 to the middle of 2022, the median income among renters rose 5%, while the rents rose 15%. So to exacerbate the problem of that affordability crisis, it absolutely plays out for that lower to middle income family range. So Michael, I love that solution, and I'm actually thrilled to hear that maybe builders are kind of stepping back and saying, how do we address this? Because as you stated, and even in the rental space, right, everything is geared toward amenities and, getting that renter, who, by the way, is a bigger demographic than we've had in many, many, many years, more of what they want to see on a property. So that means more choice, more expense, and a higher rent. And people in that middle to high income range are willing to pay it. So that's been kind of the separation in the rental space of that higher or middle to high demographic range, and then that low, which is just getting a little bit wider, that gap there. So I love hearing a solution, potentially that smaller homes, or I don't know, something else.
And Tim, the supply and demand, both of them are at work here, because the builders coming out of the great financial crisis and the housing crash of 08, 09, started building homes, but almost all move up oriented large homes. And you had D.R. Horton with Express Homes, and some of the local and regional builders like LGI started somewhat trying to cater to the entry level, but by and large, the rest of them did not, and very little of the production has been suitable for families that are just starting out, getting their first home, starting to have children, and so on. Now, the demand side, at the same time, has worsened that gap, because the millennials are 10 years late having children, so to speak, compared to prior generations, but they are starting to have children at a faster rate now. And the projections are that they're going to continue to have children at faster rates going forward over the next 5 years. And they'll want a house, they'll want a place with a yard or at least some small amount of private outdoor space. That's very much what is needed. And just in time to fill the gap, the built for rent sector has come along and started to do denser houses. You see the cottages, the horizontal multifamily projects started out in Phoenix. Now they're all over the country and starting to spread more, and they're very much in demand. But the whole gamut of single family built for rent, single townhomes for rent, they're all in demand by these young families that are starting out and need a place where they can raise kids. And if they have a dog, doubly so, because they want to have a place where they can just let the dog out the back, compared to living in an apartment where they might be living now. They see this opportunity as being so much better in terms of a more convenient lifestyle for kids.
Absolutely.
And dogs.
So let's keep moving. I want to get into expected investor activity and or origination volume. And I'll start with RCN Capital. As we look at 2023, we anticipate growing our originations significantly. We feel like there could be some market share to be picked up by maybe some of our competition that isn't weathering last year's storm, but also knowing the investors the way we know the customer. What we're hearing from the customer is the time is now. The customer is ready to go. They have been pushed out a little bit by kind of the iBuyers the last, call it, 3 years. And it's a blue ocean right now. So personally, when I look at 2023 origination investor activity, we anticipate flipping will be moderate, but the buy and hold investor will really be trying to get their foot in the door. I would like everyone to kind of quickly address kind of that topic, if you would.
Yeah, and you could relate it back to the plight of the builders too, right? The builders are looking at selling to investors as a way to take market risk off the table. These forward agreements that they can get into with the operators and so on, and just they don't have to worry about how many am I going to sell at what price. They know in advance because it's determined with a contract. But a lot of times, and Michael Finch will confirm this, sometimes the builders have to sell at a discount to retail if they don't have the optimal product for those investors. But for the investors, this is the time to strike deals with those builders. They do have those inventory units, and I think it's a fantastic time. And I think that I'll talk about my forecast later in the discussion today, but you'll see that part of the volume that I'm anticipating for 2023 comes from those pivots.
Yeah, and they're doing that.
Get to Brad's forecast and slides really quick. So, Randall, Michael, let's try to touch on this. So we got 4 more points before we can get to Brad's slides.
Sure. And to Brad's point, the builders who we work with, all of them, I mean, and a lot of the big investors are all seeing the same tapes. They have been, they've got standing inventory that was built for sale, and they are offering significant discounts to buy in bulk or even to sell one of them, whether it's to a retail consumer or an investor. The problem with the standing inventory today is that they're just bigger homes with higher end finishes because they were never intended to be rental homes. So the investors need more than a 20% discount, in a lot of cases more than 30 or 40 on those homes that were never thought to be rental homes. But what we are seeing is that the builders that have other plans on their shelf, they can build smaller homes in communities where they have finished lots. So there is opportunity, to Brad's point, for an investor to forward commit with a builder to buy 10 homes or finish out the entire subdivision, but pick a plan that's cheaper for the builder to build and still build a quality home with a renter in mind.
Well, I
think there's opportunity, but you've got to put in a little work.
That's a great point, and I think anybody listening to this call needs to hear that. No matter your size or scope, you do not have to be willing to buy 30, 40, 50 houses. Right now, if you go in and you're willing to forward commit, like Michael said, and even buy one asset, the sales manager, in many cases, will be more than happy to work with you. And you can close directly on a DSCR loan. You can close directly on a conventional mortgage. And your property manager will probably love you because it'll be the best asset you have. Right, Randall?
Yes, we will. But I'll tell you what, we are seeing in our survey of our investors and across the industry that the appetite is very strong. As you guys are talking about, it's just about matching up the correct product and being able to reach the right price that makes sense. So good appetite for 2023 for investors.
Excellent. So as we move into the debt predictions and institutionality of the space, to me, they combine. Because ultimately institutions have pulled back from the buy side because their spreadsheets missing one number, right? The constant rate. When you buy on a debt yield or a gross yield or a net yield, the rate is very much the primary driver, I would say, of your strike price. So when I look at, and as a lender, I cannot loan money for less than I have to pay for it. Just in general, it doesn't work that way. So when I look at 23 and 24, the way my mind looks at this is I think rates keep going up in general this year. I mean, there's some that say they'll flatten out. There's some that say that they may go a little too high and then have to come down a little. But I would imagine as we ring the new year bell, we'll be anywhere from 25 to 75 basis points above where we're at right now. Then, you know, in 24, I really feel like we're going to be kind of in that same territory of where we're at right now, which then will bring spreads in. And I think once the institutions, the iBuyers see rates flatten out for, you know, maybe a couple Fed meetings, I think they come back in full force. So let's go around the horn real quick. Michael, you take it.
Yeah, I'm more hopeful than that, but who knows, right? You know, but you know, for the investor, which is, you know, the big difference between today and a year ago or 2 years ago is everything was retail, as long as the numbers worked and you could cover the DSCR. Today, it's way more about cap rate, which is, again, kind of new in the home, you know, building and investor world. Not necessarily, I shouldn't say the investor world, but now it doesn't matter what the retail is, because if the retail is 300, but you can't cover your debt, well, then you need to buy that same home for 240,000. And that's how everything's being looked at today. So there's been a big shift, and cap rates are not considered equal. So when builders, you know, think they're offering a community at a 6 cap on, you know, like a little 4-page flyer, you know, they're new to the space. They've never worked with commercial investors before. So, you know, it's really up to the buyers and the investors to help educate. Hey, we love this product. You know, I believe the retail price is $300,000, but I can't pay $300,000 because the rents do not get me to a cap rate that allows me to get a loan on this property. And 97% of investors use debt. You know, it's very, very few are all cash.
And we'll go to Randall. We'll go to Randall and then Brad, we're going to make you presenter, and we'll get into your predictions and slides.
Yeah, Tim, just quickly, it seems like the theme of the day is maybe stabilization and flattening out some of those peaks and valleys. And that is an interesting thing. And I'm seeing some questions come in that hopefully we can get to around, you know, how do landlords adjust to kind of the new norm and that new rate? But Michael hit it on the head with different buying strategies. And there, guys, the cap rate can be manipulated by NOI just as much as it can by the price. So you've got to look at how you're operating on that property. And of course, the fallout and the implication is what happens to rents. And so it's very interesting to kind of see that and view it through that lens. But you know, we are flattening out on rents as well, as Brad's going to get to. And so it will be, maybe to Tim's point, a year of stabilization. That would be very interesting and very different than we're used to. So that's my 2 cents on that.
Brad?
Yeah, I mean, cap rates are really causing major changes in what's going on with the investment flow. It's putting more deals under much greater scrutiny. And you think about it for a moment, and you think about how things started to get a little softer, as I'll talk about in a minute, for build for rent lease ups in the last couple of months of last year. And that coincided with interest rates going higher, and people sort of asking you, why in the world are higher mortgage rates slowing down rental demand? It doesn't make sense. You would think it would go the other way. It's going to push more people out of being able to own and back into renting. But what's happening is that it really reflects not so much the higher interest rates, but it reflects the people's fear that a recession is coming. But again, higher cap rates equals more scrutiny. I'm going to go ahead and share my screen now, and let me know if it's in the right configuration. Can you see it now? Does it look right?
Yeah, we can. And right before you do that, Brad, we can just leave that up there. Randall, I have a note here that I wanted to bring up the NARPM survey. And real quick, before, do you want to talk about vacancy rates before or after Brad's slides?
I can go after because I think it'll tie in with Brad's pretty well.
Perfect. All right. So Brad, take it away.
All right. Do I need to swap the screen, or is it on the correct mode right now?
You're good. Go ahead.
Okay, excellent, excellent. Okay. So just to start off with my forecast for build for rent, 2023 is going to be another up year for build for rent volume, unit volume, but there's an asterisk on that statement, right? We're seeing slower leasing paces in some areas in our studies that we do around the country. By 2024, 2025, though, it'll be back to the races with stronger demand and stronger rent growth. Recession fears are causing people to change their behavior. It's slowing down household formations. In other words, people who are currently renting and they have a roommate or they're staying with parents or relatives, they're holding off and saying, let me wait a little bit, see how the economy looks, see how I feel about my job security and my income a few months down the line. But I think that as we get into the middle of next year or middle of this year, we'll start to see people say, okay, I still have my job. Everybody that I know still has their job. I'm okay. I can get on with life and go ahead and move ahead with my plans. So rents are peaking and declining in a number of markets, but the Southeast is still very strong.
Brad, if you're advancing your slides, it has not changed.
I haven't advanced yet, but thanks for telling me. All right, here we go. Now, this shows the actual data from CoreLogic. It's the single family rent index, which is kind of paired comparisons with the same property 2 points in time. And what we're seeing is that the last 4 months, we've seen declines in the actual number. Now, let me advance that forward to show my forecast. And by the way, people get distracted by year over year comparisons. When you look year over year, it looks like we haven't had any declines yet, but month over month we have. So here's my forecast. I'm saying that we're going to go down about 6% between the peak in last summer, fall, until what I call the trough in around August, September of this year. And then after that, we're going to get back to what I estimate to be 3 to 5% annual growth, and then trending back up to above 5% annual rent growth going forward.
Brad, just to make sense of the slide, on the left-hand axis, what is the nominal?
The scale, yeah, the scale, it's an index, so they index it based on January of 2011 equals 100. And this is a national average. And as you can well imagine, this national average is greatly affected by what's happening with rents in Las Vegas and certain parts of Phoenix and the Bay Area and parts of Austin. And then this graph actually is the same graph, but going and showing more history. So here, instead of just starting in 2021, I started in 2017. So it puts it into perspective a little better and shows you that it's not a big dip. It's really just a minor dip that just at the very bottom takes us back to early 2022, late 2021 rents, and then we recover from there. So at this point, I'd like to kind of kick this to the panel and see if this kind of rings true with you guys, with your experience, with what you're seeing in the market, And, does it line up with your expectations about when we're going to kind of start to recover again?
I'm going to go first on that, because ultimately, just like everything else I'm seeing in the market, it seems like a reversion to the norm versus a correction or crash. And if you were to put a straight line from the left axis to the left to the right, where basically your forecast would say the party times are over and it's time to get back to normal. So it seems like a reversion to the mean.
Yeah, that's right. We're kind of correcting for over exuberance in the last 2-3 years.
Yeah, which clearly is necessary because people are getting priced out of homes and priced out of rents. And I think this flows very, very similarly to what we're seeing happening on deals that we're working on with builders, and we're negotiating pricing adjustments with them that are matching where we're seeing the rents, so we can make sure that we're buying right. And aside from all the turmoil that's been going on, there's also a seasonality that's been paired on top of where we've been as well the last few months. It is historically normal for new leases in November and December because of the holidays, and it's winter time and people don't like to move. So, to Brad's point, it will start opening up as we enter the spring season again. But yeah, we've definitely needed a slowdown in rents because, like we all know, trees don't grow to the sky, and we've got to have tenants, and we can't be outpricing them, but we have also got to buy homes right to make sure that we can put the tenants in place that can afford the homes that we're buying.
So I'll jump in on that too, because guys, anecdotally, this may surprise you. Michael, we're used to that up and down, of course, in the winter and the slowing, but right now we're still seeing a very interesting crunch on the demand. So what that looks like is, for example, I had a property in New Jersey a month ago that franchisee there listed for $6,000 a month. And he thought, oh, this is probably going to take me a few weeks to rent. Within 3 days, he had 14 applications for that property. And that's a trend that we're seeing all over the place. So we are still seeing kind of a crunch on the demand side. We're not really seeing, to Brad's point, rents continue to increase. Definitely more of a stabilization that we're seeing across our portfolio. However, there's still a shortage. I don't want to lose sight of that, for especially, and again, maybe the 6,000 wasn't the best example for this, but anything in that lower to mid range is going to fly off the market in times that we're not used to. So I feel like we're still kind of, in some ways, maybe the blip or maybe the follow-up post-pandemic is where we're at, but it's an unusual cycle that we're in right now from the rental perspective.
But to be clear, we're still seeing rent growth. It's just not as fast.
Right.
It's not as fast. Yeah, it's not the 15 to 25% that we saw between 2021 and 2022.
And I'm an older guy now, and I can remember when you could get $20 more every year. Like, that was great. Right. Like, so I think the exuberance and the spoiled nature of all of us in the kind of post-pandemic world, and literally Brad's chart from September of 20 through September of 22, we can just literally visually see it was stupid, and we're getting back to normal. So we are going to run way out of time if we don't move on. So next slide.
Okay. And to the point about the supply crunch, I offer my forecast of volume. And what I'm showing here is how many built for rent units I expect to be added each year. And you'll notice it slows down its pace a little bit this year. 2023 is not up as much percentage-wise as it was the previous 2 years. And then it goes back up again at a very rapid pace in 2024, 2025. So again, this slightly slower increase in 2023 is just because of those recession fears causing some decrease in household formation rates. But I think we get back up to, strong household formation rates as these millennials are looking for something better than apartments. And plus a lot of demand in the 55 plus, and then people in their 40s as well, a lot of divorcees and single people, the whole gamut. But the families are a big part of it. And I think that what this is illustrating, in my point of view, is that we're going to be chasing demand all the way through 2027. I think that we're at 95% occupancy all the way through this whole period. So we're not in any danger of overbuilding, at least in an aggregate national level. Maybe certain submarkets, we have to be careful and make sure that we're stratifying and diversifying. But I think that there's a huge potential for more growth. I think we're going to get up to built for rent being 15% or more of housing starts, single family housing starts. So again, I'll offer this for discussion and kicking around by the panel. How do you guys react to this?
I was going to ask Brad, because this chart doesn't, and you just sort of mentioned it, but prior to today, build for rent has been roughly 4 to 6% of total home starts historically, and I think that goes back quite a while before people were even calling it build for rent. But moving forward here, does this kind of follow your 15% rule as we go into 24 through 27, or do you see that moderating a little bit, as they build more for sale product?
Very good question. So first of all, I've seen that 6% number in the press quite a lot, but that's actually not quite accurate, because it's based on census numbers that are from a series that the Census Bureau collects, which is housing starts by purpose. And the thing is, the Census Bureau numbers do not take into account fully all of the units that are being built by the builders for sale to a third party operator or investor.
Yeah.
Not picking it up. So that's why you'll notice my 2022 number is 119,000. If you look at most articles, they're saying it's like 60, 65,000.
Yeah.
So almost half the market. So we're probably at 9%, approaching 10% already. And I think it's going to be quite possible to get to 15, 16% of single family housing starts by 2027, 2028.
Which I think is important to note, because a majority, I think the number is somewhere around 36% of apartment tenants that move out prefer to move into a single family home. And that has not been an option for a huge number of people over time that didn't want to buy a home. So built for rent is needed, because there's a large portion of people that may want to buy a home in 3 or 4 years, get out of their 2-bedroom apartment, but they want that 3-bedroom home, but they still got to work on debt and credit issues, but they haven't had the option previously to move into a premier rental community that's offering them what they want, and that's finally occurring, which I think is a positive.
That's right. Yeah, more and more of these.
I think that's a good point.
Yeah.
Sorry, Brad. I think that's a good point, Michael, because I feel like build for rent was a good answer to the need in the marketplace, and that need for that middle to low, as we talked about earlier, still hasn't been met. But maybe with the adjustment and what you were talking about earlier about the type of property where you could still move out into a nice community, get some amenities, and stay in that. And we know that today's renter is okay staying that way for much longer than we've ever seen before. And the build for rent is going to hopefully pick up, as Brad's predicting.
Folks, let's move to the next slide, or is that it?
There's one more. And then, so this is just real quick. This is just a survey that we did of 500 renters that were renting in suburban apartments. And we asked them, how much more would you pay to move up from your suburban rental apartment to a single family home? And this is, we did it for townhomes and single family detached. This is single family detached. And here we broke out the data results by the income range of those respondents, and just kind of draw your attention to the gray line, just to pick one that's the most relevant. People making 90 to 130,000 household income, they're willing to pay, 50% of them say that they would pay $350 or more per month to move up. And so again, that's part of that investment thesis that shows what people are willing to pay. And that number is probably higher in a lot of places, but this is just the national average.
Yeah, and it's a staggering number. I mean, when and these are the tenants that are today living in, newly built apartments as of the last 3 to 4 years, and 1 and 2 bedroom apartments are averaging $1,800 to $2,200 a month for Class A product. So you've got a tenant base that wants more space and is willing to pay $2,200 to $2,500 to live in a quality single family home. That's and you can back in on where you need to, what you need to purchase that home for to hit your return, based on that metric. But I mean, those are big numbers, 200 to 400 or 250 to 350 increases.
Yeah, exactly.
Absolutely.
Stop sharing so you guys can continue on.
All right, so Randall, the property management industry report.
Yeah, so interesting study done just about 6 months ago by RealPage in conjunction with Billiam Propertyware and NARPM, which is the National Association of Residential Property Managers. Really interesting to how they're segmenting and looking at the changing investor database. So this is interesting, just kind of to take a look at what type of investors are we seeing today. We are seeing a move from the right side of the screen to the left side of the screen, to the middle and to the left, right? So we're seeing a higher percentage of intentional investors, people that are starting off that way. It may not be surprising to you, but guys, there is a whole new generation of investors who are millennials. I just said it. Millennials are out there buying investment property. And so we're starting to see that demographic change a bit. Now, will the interest rate and will this new product change that? It could potentially, but at the same time, those same people are willing to rent for longer and willing to invest faster. So with the backing out of institutional a bit, maybe I'm jumping the gun a bit, but we are going to see this millennial generation come in force and start to buy. So very interesting slide, and you can kind of read through that. And this represents the shift that I'm talking about, right? If you look at the intentional and the unintentional investors, they now represent, and this is again self-identified, 75 or just above that % of the marketplace. So really, really interesting to see that shift, that slow shift over time into intention. And it matches up, guys, with the renter demographic that we're seeing today. Now, this is where I talked earlier about whether or not there's a bullish sense, right? What are the rental owners' plans? And you guys, you can see a very clear shift to a likelihood to sell, or actually an unlikely to sell down there at the bottom. So we are seeing a very strong market, a very strong future prediction here by this demographic. And I am not the economist, so Brad, if you want to weigh in on that slide or the previous one and kind of give your thoughts, is that in line with what you're seeing?
Yeah, I think it is. I think that people are realizing that, you look around at where you want to invest your money, and, honestly, I can't think of too many places at this moment that are better than having rental property. Personally, I'm waiting for another leg down in the stock market before I jump back into that, but who knows whether I'll be right or wrong on that one. I've been wrong before in the stock market.
Well, as an investor, right, if you pull up your spreadsheet of the properties you owned 4 years ago and benchmark it against the ones that you own today, if any of them are the same, I mean, you fall out of your chair. So, of course, you're not wanting to sell, right? Because you're wanting another leg up or two. And so I think this is great data, and it's been fun to watch it progress over the 20 plus years of my career, because when I got into this business, most people were accidental landlords, and that's the big major reason that 80 or 90%, I can't remember what it was way back then, only owned one, because they didn't mean to and they didn't really want to, but heck, they had it, they might as well keep it. So since we're going to run out of time for questions, I want to go ahead and progress through your slides, Randall.
Yeah, the only thing I want to note here, and I do want, since you asked earlier about vacancy rates, just to give you a sense, guys, vacancy rates are the lowest they've been since I was in 3rd grade. Okay, so that was a very long time ago. 1985 was the last time we had vacancy rates around 5%, which is where we are. So if you're out there and you're thinking, and I saw a question in here come in about cap rate and NOI, And I think we may see a little bit of a shift in some of those calculations. Again, you know, the inventory crunch that's happening. And so that's leading to a very, very low vacancy, which is interesting. So renters very bullish, or rental owners very bullish on revenue growth. Maybe not surprising there, but it tells that story. And I think I might have one more here, Tim, to talk about. This is where we've hit on the demographic, guys. This shows a very interesting correlation in the rising incomes that we are seeing. But there is still that crunch in the affordability housing that is happening on that lower end side, although we did see an increase in incomes among those renter households. But I've got a statistic here that might surprise and shock some of you. 46% of today's renters are spending more than a third of their income on housing, and 24% are spending more than half of their income on housing. So we really are still in this situation where the need for those is just great. So anyway, I'll stop there, maybe get some thoughts on these slides.
I'll tell you.
Oh, go ahead, Brad.
Yeah, I was going to say that those statistics about the lower end are contrasted with the fact that people who are renting in Class A apartments are only spending about 28%, I think it is, according to a study from RealPage, of their income on rent. So there's room. You know, they're not in that income category, in that tranche of the demographic world. They're not overly squeezed, which was it really interesting for me to see. I think that was a really interesting result. And we're seeing that from that same data source, RealPage, they showed that income growth, I think if you annualize it out, it comes to around 11% over the last year, which is way higher than the average for the population as a whole. So those people in Class A and similar kinds of apartments are progressing in their careers and getting more income and so on.
So
I think, go ahead, Tim. I was just going to make a comment on one of the slides that Tim had up earlier on the millennials being big intentional investors, and I think it's incumbent on everybody that's listening and the big operators and mid-tier and the idea of the American dream, I think everybody realizes is changing, and our industry gets a lot of pushback that we're ruining the American dream, which I 100% disagree with, of course. But I think, and I'm seeing it with younger employees that we have here, where millennials are looking at buying a house maybe to live in, but also renting out some bedrooms because they're planning on having it become a rental in the future. And it's a different view on what the old American dream was, which is just always buy a house, build your wealth. Well, now we've got millennials seeing a lot of opportunities, not just in the housing market to generate wealth, but in the stock market and access information. But it's a new way to describe how to achieve the American dream. You can buy your first house as a young 25 or 30-year-old millennial. Maybe you're moving in with your boyfriend or girlfriend, but you might have 2 more bedrooms, and they don't mind living with others because they've been doing it for so long. Now they're getting their mortgage covered, and maybe they take a job in a few years, but they own a home and they just continue running it. So, there's nobody's talking about it. But I love that comment, Randall, because I think it's really important that the younger generations are looking at housing a little bit differently and given an opportunity to not just buy their first house, but then rent some of the rooms that they're living in their first house, and eventually it turns into a rental. So it's kind of like a double intention.
And that is very important. And it's also important to finish on time. So we have 10 minutes left. So we're going to get to Q&A. First off, most common question, can you get the slides? Yes. How will they be sent? Via email to the people that have registered and attended, and as well as the recording. So that's the main questions. Now, Sean, a question. Average landlord net profits dropped by 50% with 7.25 rates versus 4% a year ago. How does the landlord keep up with higher rates? Let's go to Michael first.
It's all about buying right. Hopefully you don't have some adjustable rates that are going to start creeping up here soon. But, moving forward from today, knowing that you have higher rates, you've got to buy a cheaper home. And I mean, it's just, everything is about the buy in real estate, and everything's got to pencil. Rates are what they are.
And Brad.
Same thing as Michael said, I'll save time.
Randall.
Oh man, again, there's two ways to impact that cap rate. The other side is the NOI, and looking at how efficiently you're running that property, looking at what tenants are willing to pay for today as for amenities. I'll give you one example of that. Our average tenant in our system is willing to pay $50 or more per month for a pet, and 70% of tenants have pets. They're willing to pay for amenities in a way that is not always reflected on straight up rents, but definitely is very impactful on that bottom line. So remember the NOI as well.
Let's stay on
that.
topic.
A lot of that's with the property manager, right, Randall? I mean, you should interview your property manager who's operating more efficiently than another. There's a big difference between.
Absolutely.
Because one of the questions from Brad was, are units like for like, generally apartments are smaller square footages? And I think that goes back to Brad's comments about people opting for single family versus or wanting a yard. What are you seeing? And does that make sense, Brad? Or did I phrase that right? It was 10 minutes ago.
Yeah. So when people it depends on who that person is. Sometimes you have the young families that are saying, we need more space, and maybe throw into the mix that they might need more space for a home office if they work from home for certain days of the week. You can't really work well in a 2-bedroom place. What are you going to do? You're going to have your second bedroom be the office, and then it's a little cramped. So people are going to tend to want that larger square footage, or at least some way that they can work in some office space. If they have kids, they're going to need a bedroom for the kids. So it's all about lifestyle. You also have the other end of the spectrum where people are empty nesters and they're saying, I don't need this big 4 or 5 bedroom house anymore. And so it's a move down scenario. So I think that the square footage that is needed is I think that the build for rent sector has so many different ways to meet the needs of the different households. Does that answer the question, or did I miss part of it?
Yeah, it's hard to put it into context because I didn't catch when it came in and what slide was on the screen. So in the interest of time, I do want to just go ahead and move on. I feel like you answered a question. It may not have been the question. So what is the current average number of properties that, I'm sorry, I skipped one. Is qualifying for rent much easier than qualifying for a mortgage? Randall already answered this via text. I would say yes, and I would agree with you, Randall, because ultimately the qualifying for mortgage, the pool of note buyers is so small right now. You're really only looking at government-backed programs. So that's one kind of standard. Whereas with the rental property, depending on if you're dealing with an institutional landlord or an individual landlord, they can set their individual terms or even be okay with mitigants, co-signers and things like that.
Yeah, and the other thing I'll just mention quickly is that there's a lot of tech innovation and new opportunities for renters to qualify in a different way. I'll give you an example. We use like Plaid integration to be able to verify income in a way that we've never been able to do. We also are just offering, again, as I've mentioned before, many more amenities, and the screening process is just a lot more streamlined than maybe you're thinking about. If you're an investor out there and you're like, I wonder how property managers today are screening, it is a lot more factors that go into that than credit score. In fact, credit score is becoming much less important in the underwriting world for rentals than it may on the loan side. So definitely would say yes on that question.
Michael, do you have something to add? All right. So what is the current average number of properties an investor owns? I do not know the answer to that. I see what Randall typed. He said, good question. 90%, HUD says 90% of the 25 million SFR are investors 10 or less. I think a lot of those studies and outputs have been convoluted lately because of what people call an institution. It went from 500 or more to 50 or more to some of them classify 5 or more as an institution. So I have not looked at the numbers recently. I would like to, but why don't we go around the horn because I know you guys have.
I mean, I'll go first because I think Brad's probably going to have the most number, but it's that own a majority of rental homes own 3 or less, and then, it just sort of tiers up. Once you're above 10, it's a much smaller demographic, and once you're above 50 or 100, there's very few that own that many. It's still a big number, but not compared to the large swath that own 2 or 3 rental homes.
I think the key point, and it's similar to what you said, Tim, is a lot of people that haven't really dug into this sector think that the institutions own the majority of rental properties, rental homes, but it's absolutely not the case. I've seen numbers in the range of 2%, maybe it's creeping up to 3%, but it's still in the low percentages that are owned by institutions. Most of these rental homes are owned by regular people, just individual landlords. And so, to kind of tag on to something Michael said too, I agree that there's a lot of kind of negative vibe around build for rent because of the concern about that. But build for rent really shouldn't have any of that taint to it, because you've got new homes being delivered and built for this purpose. It's not taking away from anything.
Exactly. And I think that on average, historically, the market's always been 30% investors and the rest more traditional home buyers. And in most local markets, that number has not fluctuated very much. It is the local investors, the local people that know their market, that are outbidding the institutions on those one-off homes, like the Invitation Homes and guys that buy off the MLS. It's the local investors that know where the deals are coming up, and they're buying way more homes and still controlling the market at a much higher level than the institutions.
Yeah, and I'm since we have 3 minutes left, I'm gonna kind of tie everything together. So last question from Rick: is there legislation in the works trying to discourage the huge institutional owners from acquiring more rentals in the future, worried that it will dominate in 2030, if not slow down? Number one, yes, there is legislation always trying to discourage a lot of capitalism. And I would say that there's a lobbying group that all the big institutions are a part of. All legislation is good and all legislation is bad. I think the same way that we've seen the multifamily industry evolve from the 80s to now, you're going to continue to see Class A single family in top 20 MSAs evolve. Ultimately, the grade A primo stuff and the grade A primo areas are going to be owned by the people that buy on cap rates, not on down payment. And so if you're worried about it, find a way to raise money based off of cap rate would be my opinion, or just keep track of where they're buying and go somewhere else. That's what I've had to do in Dallas Fort Worth. And my favorite question today: are the millennials who are investing in real estate also the ones investing in cryptocurrencies and NFTs? No, but they may be the millennials that are selling their NFTs and cryptocurrency because they realized it was a wild fun ride, and it's pretty much over for now. So
selling them to who, Tim? Selling them to who? Who's buying?
Yeah, I don't know. It's Bankman-Fried. So 30-second elevator pitches on the way out the door. Michael, you're first.
30 seconds. I'm just a big believer that we've got a lot of tailwinds ahead. I think to Brad's point and Tim, to your point, to one of the questions, the home building industry has a big lobby too. And, we're a country built on choice, and people want to rent homes, and the home builders want to build homes, and they absolutely want to build homes to people that want to own them. But now they recognize there's ability to build product that isn't taking it away from home buyers. They're purpose building communities that investors are buying to rent because people are wanting to rent single family homes. Big tailwinds, I think, for the build for rent industry for a long time to come.
Brad?
The number one driver for build for rent is young families that are just starting to have children, need a yard and a place in the suburbs for kids to play, other kids in the neighborhood, these kinds of things. And their needs have not been served hardly at all for the past 10 years. So along comes build for rent to come in and provide something that's badly needed. And I'm excited to watch this evolve.
And Randall?
Great discussion, and I love the optimism from everybody on the call. I will say that I am an optimist as well, because there is a class of investor, and many of those may be on the call today, who are looking to buy, and they're hungry and anxious. They've got the appetite. Guys, find yourself a good property manager who can help you identify properties outside of your MSA. Look to capitalize on areas where you can still get amazing deals. Look in the Midwest and other markets and look to these guys to help deliver some of those, because they are still out there and there is a ton for buying. Rick, don't worry about the institutional guys. They make up just a tiny little percentage as compared to you, me, and the rest of us who are just trying to build one portfolio, one property at a time.
Ladies and gentlemen, that concludes today's call. I'm Tim Herriage. Remember, food, water, shelter, 3 things all humans need. And as my good friend Rick Sharga said, most people, they ran an extensive poll, and most people prefer to sleep indoors. So we're out of time. Thank you for your time, and we will see you next time. Good luck and God bless.
Thank you, everybody.
Thank you.